If you have some inkling about or some interest in the private credit industry and all the fears around AI disrupting that, at least globally, if not in India, then the next conversation is for you. A sharp conversation with Sachin Desai, MD of Investments at Mosaic Asset Management, and Rubin Chedda, MD and Head Special Situations Credit Fund at Neo Asset Management. Gentlemen, both of you, thank you so much for joining in. And the genesis of this is every day wake up to a fear of what disruption can AI cause. And in the Western world, AI disrupting the tech world, and therefore some of the lending that is being done by the private credit industry to this space is going to be challenged. That's the narrative, and everybody's subscribing to it. Sachin, would you subscribe to that or no? Why?
Yeah, basically, the thing is, I think no one really knows in the ultimate analysis how this will play out. What has happened is that you have these very capable AI models and the agents that, say, Cloud has released, and they are able to kind of automate, or you can say vibe code some of your workflows. A lot of the software that otherwise used to come via SaaS can be done in-house. And the fear is that more and more companies will maybe just hire a bunch of experts slash maybe even part-time coders and do in-house a lot of stuff which otherwise had to be done professionally, and where it was a per seat kind of an arrangement in terms of SaaS with annual increases. The detractors, on the other hand, are saying that no, this is not the case because this is enterprise-grade software where data integrity, compliance, regulatory compliance, etc., is very, very important. So people are not just going to wipe their way to enterprise-grade software. And yes, AI will add a layer which will be very useful, but that is something that has to be necessarily done by experts, either SaaS companies. I think the market is kind of in what you could call in economic terms a Knightian uncertainty. You do not really know how this will play out. So whatever growth and PE multiples were baked into the companies, valuations have kind of come down drastically. Maybe the fear is well-founded and the companies deserve lower valuations. Maybe the fear is unfounded and
Sachin, I'd like to come in here because, frankly, I mean, the valuation is one part, and Rubin, I'd like to get you in this conversation. One part is the valuation, but the other part is that could there be genuine losses on the loans that have been given to some of those firms? And then I'll tie it to the Indian context, whether there is merit or no. But Rubin, could there be genuine problems for private credit loans, if I can call it loans, or money is extended to global firms on the tech side because AI is disrupting them?
So, not at all. We are actually far from it. See, I'll give you some very simple yet very impactful statistics. If you look at the Indian private credit market, we are a very small niche.
Rubin, sorry to interrupt you. Right now, I'm not talking about India. I'm talking about the West right now.
See, in the West, yes, I am a little concerned because in the West, private credit has now become a mainstream. US private credit market currently is around $2.3 trillion, and annual deployment is $600 to $700 billion. So in the overall GDP context of US, say, which is say around 30 trillion, it has become a mainstream, and it is a little worrying the way things are right now.
Okay. Fair call. Now, before I come to the Indian private credit scenario, Sachin, could it happen that if there is a private credit winter in the West, could it have an impact on how people view the private credit industry in India? Factually, maybe correct or incorrect is a separate question altogether.
You see, definitely, we have informed investors. It's a well-networked world that we live in. So any event that happens abroad will definitely pose questions as to whether something similar could happen in India, because we live in an interconnected world. But I believe, as Rubin was alluding to, the reality of the Indian markets is very, very different as compared to the US. For instance, here we have essentially close-ended funds, and where only qualifying investors can invest. So the guardrails are in place. Unlike US, where a lot of private credit funds also take leverage, they have quarterly windows and a lot of retail participation. So here we believe that when we explain the differences that are structurally present in India versus the US market, that should be a good message to give to the investors as to why the two markets are fundamentally different. And it's unlikely that what is playing out in the US would play out in India as well.
Fair point. And I'd like Rubin to add to this, but viewers, the reason why this becomes important to have this conversation as well, because while a lot of retail money may not be going into private credit, we've seen this industry in India grow leaps and bounds over the last 5 years, and there is a significant amount of capital that now rests with the private credit firms, which they are co-lending, if you will, or lending into the Indian infra and other ecosystem. Now, Rubin, you were making that point earlier about how India is different. Sachin alluded to it. You want to make that point as well?
Yeah. So in India, we are right now in a very early stage of evolution as far as the private credit industry is concerned. If you look at the total private credit AUM in India is just about $35 billion, and annual deployment is in the range of $12 to $15 billion. Now, in the context of our GDP of say $4 trillion, and in the context of our relevant market, which is say the corporate bond market and the wholesale loan market, that's about $1.7 trillion. So we are just a small niche. We are a blip. We are just about 2%, and in a very early stage of evolution. So there is no systemic risk, number one. Number two, Indian private credit firms operate very differently compared to the West. Our leverage levels, when we lend money, we are typically lending at below 4x debt to EBITDA. In US, typically private credit funds exceed 6x. So there is an inherent risk there. Our structures are very different. We are typically lending in senior secured instruments or senior instruments. In US, typically you have a lot of fancy structuring like mezzanine, junior tranche, etc., etc. So there is a very fancy slicing that happens in the US market. Number three, most important point, we are a very collateral heavy and covenant heavy market. In US, there is very loose covenants and very low collateral because these are all typical syndicated loans. In India, we have bilateral conversations and very heavy on both covenants and collateral. And lastly, very macro point, if you look at our current corporate balance sheet strength, bank balance sheet strength, we are actually in a very nice zone. Thanks to the post-COVID rally, a lot of corporates have deleveraged by raising equity. Banks are in very good shape in the last 2 decades, I would say. So in India, contrary to what's happening in the West, we are actually in a very benign credit cycle. And this should last for the next 4 to 5 years at least.
Okay. Yeah, the cycle in India different. It started off late, maybe still at the nascent stage. Let's see how long it lasts. But clearly, the two experts who, of course, remember viewers, run private credit funds in their own right in India, believe that that space is very different in India versus what's happening in the West currently. Thank you so much, gentlemen, for joining in for this very quick conversation.